Hey everyone, me Kevin here. I just want to give a sincere thank you before we get into this CPI stuff to all of my supporters, because yesterday I ran a poll on Twitter and I basically asked if I'm a certified flip-flopper and I should just own it, or if I have the right to change my mind and I'd be dumb not to change my mind if certain conditions change. And the poll was kind of split between, you're a certified flip-flopper and you have the right to change your mind when things change, and thank you for giving us a heads up when things change. Which that's what I always want to do. The problem with that is if you're too transparent and you're like one of the first people to change your mind, well, then you get all the hate that goes with it. It's a problem, but oh well, I'll deal with it. But the third option I gave was, I just hate you. You can go check this out on Twitter at RealMeatKevin. And I got like 17% votes on that. I'm like, at first I was really disappointed because I'm like, wow, 17% of people literally interact with me solely to hate me. And I'm like, okay. Then I compared myself to Trump or Biden, and I'm like, wait, that's actually not that bad. So I felt a lot better. But anyway, I guess that makes sense. And it kind of explains why sometimes there's some people, I mean, you must just have a miserable life if you're leaving hate comments all the time. But oh well. So thank you to the 83% of you who are supporters, and to the 17% of you, I just wish you the best, a better life, because hating is quite exhausting. So thank you. And as a thank you to everyone, including my haters, you can now get up to 12 totally free stocks by going to metkevin.com/Weeble. Go to metkevin.com/Weeble, deposit any amount of money, and get up to 12 totally free stocks. Okay, now let's talk about CPI data. So tomorrow we get CPI data. It's at like 5:30 a.m. It's like a really tiring kind of time of the day. And like the good old days, I'll actually be covering that live. And I want to be very clear, inflation is bad. It hurts lower end consumers substantially. This morning in the course member live stream, we were going through the American Express earnings call, and it's really not a shocker that at American Express, they're seeing an increase of real transactional growth. This is above and beyond inflation. They're saying the spending growth they're seeing is not just inflation driven, because usually when I talk about, spending going up, people are like, well, of course spending is going up. It's because of inflation. And it's like, well, it's not only that. But one of the things that I think is really interesting is you do see at American Express this, quote, no significant signs of stress in their consumer base. And it's really important to know that the American Express consumer is a lot wealthier and typically has a higher credit score than any other consumer, maybe like more of a Capital One or like a Citi kind of MasterCard kind of customer. Or even honestly, Apple Card kind of customer, where the credit standards are a little lower. Actually, in the case of Apple, a lot lower. By the way, if you have a bad credit score and you want to build your credit, like, shout out to the Apple Card. You can get into that thing with like a Pulse and like a 580 credit score. Okay, it's crazy. But anyway, they just want you to buy the freaking iPhone, okay? But anyway, one of the things that I've been talking about since the beginning of the year, when I was talking about sort of the stress of 2020 and the hell that we were about to go through, is that you probably want to position yourself to where there's a higher income demographic. And for me, that was remarkably Tesla. Of course, another high income demographic stock would be something like, an end phase, right? Although you do have the potential headwinds that in Q1, Q2 of 2023, you have this housing market disaster that leads even higher net worth individuals to stop spending on upgrades on their homes, even though there's a really good tax advantage to spending money on solar. But regardless here, the point is higher income consumers are obviously going to be a lot less stressed by inflation. And so that's something to keep in mind when you're looking at stocks. And it's one of the reasons I've chosen Tesla to sort of ride the disaster of 2020 through. But of course, there are other higher income stocks you could look at as well. Again, whether that's Enphase or American Express or others that cater to higher income demographics. It's good to know because it's the lower income ones who get hurt more through inflation. And that's terrible. Procter & Gamble at the beginning of the year was bragging about how their consumers were not downgrading to cheaper products yet, and I'm like, ooh, you just wait. Now they're complaining about consumers downgrading because the people who were buying the Gillette razors with their stimmy checks now are like, yeah, okay, maybe we got to go back to the store brand ones. And that's okay. It just means less margin for companies like Procter & Gamble, right? And in fact, I think that's a smart thing to do. I think most of the time, you should just buy store brand stuff. Like personally, I buy store brand stuff too. Like I just like the brand name is just a freaking name. Okay, Planters is probably making the same freaking peanuts in the Archer Farm stuff as they are in the Planters box. or can or whatever. Anyway, now one place we're actually not seeing this sort of disinflation is actually rent. And that's because of something known as inertial inflation. Now that's a really fancy phrase, but basically inertial inflation just causes more pain to people, and it's a terrible thing. See, inertial inflation is basically when you say to home buyers, boom, you're not allowed to buy a home because interest rates just skyrocketed. And so that makes it more expensive to purchase a home. And so what individuals then say is, well, golly, okay, I won't purchase a home then, because if home prices are still relatively high and my purchasing power just got eradicated by 35%, basically homes are much more expensive on a monthly basis, I'll just stay a renter. And if you stay a renter, then you put more demand on properties for rent, and rents actually go up even as prices potentially go down. Now, that's really bad for renters, but it's also very great for investors. And it's why I'm launching a company called House Hack, which in the future will give equity to tenants, which will be really, really cool. I can't wait for that. That's our expectation, at least. But anyway, you could learn more about House Hack in my startup by going to househack.com. We are accepting investments from accredited investors and soon to non-accredited investors, but I'm still working on that. The SEC takes like 9 months for that, but don't worry, I haven't forgotten about non-accredited investors, so stay tuned. Anyway, talking about rent inflation, it's really important to remember that rent makes up 32.9% of the CPI report. And unfortunately, because of inertial inflation, we're still going to have high CPI reports for a while because it's going to be a bit before rents actually start coming down. The problem with this is it actually risks the Federal Reserve being a little overly aggressive, because even though we might see inflation go from 9% to 7% or 6%, if CPI is still being propped up by high rents, the Fed is going to continue being aggressive for longer, and this is where a lot of individuals say the Fed risks potentially making a policy mistake, because even though their actions are crushing demand and crushing the market, inertial inflation is in a weird way keeping rents higher, even though they should be coming down. Part of that is because of CPI having this really stupid way of calculating rents. So initially, rents are going to go up due to inertial inflation, then they'll come down, but when they come down, it's gonna take like 6 months for us to actually see them come down, because they use a stupid way to calculate rent called owner's equivalent rents, and it tends to lag by 6 months. So in other words, you get this terrible thing where, like, even as overall inflation might go down, rent inflation is going to keep us propped up for longer. And then even though rent actually might start eventually coming down, we won't see that in CPI for another 6 months. So it's like, it's like a terrible thing, right? So what are the projections for tomorrow? So let's hit those and then wrap it up here. So I've got ahead and written these down right here, so you have these. Although this is a little bit messy, we could okay. I mean, we could just throw them up. I do want to mention that there are 3 big things that we want to watch for. It's CPI for the United States. It's PPI, Producer Price Index, for the United States tomorrow, and then we'll also talk about the United Kingdom's CPI release tomorrow. I do also want to briefly talk about what I think might happen in the stock market. So we'll talk about that in just a moment. But let's take a look at this. So here, the month-over-month expectation for CPI is expected to be negative 0.1%. The last read was 0%, so totally flat. We do have a range of -4 to 0.2. So that actually has a little bit more of a bias to the downside. So we could get a really nice negative read tomorrow, like -0.2, -0.3. That would be phenomenal. Year over year, we're expecting to go down to 8% from 8.5. This is a little bit of a skewed bell curve where it's really heavily skewed towards about 8%, although we do have a range from 7.9 to 8.3. It'd be nice if we could see something come in like even below that, like 7.8 or 7.7, right? Core, when you take out food or energy, is expected to be stable at 0.3%. This is actually not that bad, because if you annualize that, you'll end up being at 3.6%, which that would be acceptable. Now, PPI that comes out on Wednesday, we're expecting year over year to come down to 7.1 versus 7.6. Month over month, not declining as much as previously. Last month it declined 0.5%, now expecting 0.1. And then the 5th largest economy in the world, right here, followed by California, right? But That's not a country I wrote here because, well, California is not a country, but if it were a country, California would be bigger than the United Kingdom. But they do have a CPI release tomorrow, which is kind of cool. However, what's not cool is that you're not actually expecting much movement in the United Kingdom. You're actually expecting inflation to go from 10.1% to 10%. So you're going to see more pain in Europe for, I think, a lot longer. And I think that's why the dollar is so much relatively stronger to the euro right now, because there is a lot more pain in Europe than what we're experiencing here. And it's not just energy either, because if you look at core, you can see core is 6.2 versus 6.2. So even if you take out food and energy, you're still not seeing a decline in the United Kingdom. So you've got these macro implications as well, where it's not just a United States phenomenon that we have all this crazy inflation, right? It's entirely global. So, okay, let's now go ahead and jump into my expectations for the stock market. Now, we briefly touched on this morning in the course member live stream, which if you want to be part of those, we usually do them around with the opening bell. You can join any of the courses and you get to be part of them. The biggest and most popular right now is the Zero to Millionaire Real Estate Investing course. You could use the coupon code link down below called SEED for the best pricing we have at the moment. And let's just talk about my expectations for the QQQ. So I think the biggest fear that people have is that the NASDAQ is going to retrace to lower levels from June. But it's really important to remember that in June, we were expecting inflation of like 8.8% and we got like 9.1%. Like it was terrible. It was July for June, right? It was absolutely terrible. And so this really helped our stock market fall to low levels because we had two bad reports in a row, both the report that came out in June and the report that came out in July. And we didn't end up peaking in March as expected. So things really ended up getting worse and not better. Now, though, we're seeing more broadly, things are really getting better rather than worse, especially with commodity prices falling. The bubble is out of oil and wheat and other commodities. We've got Russia retreating from Kharkiv, which is phenomenal. The Ukrainians are absolutely kicking butt, so good for them. But in the meantime, what it would really take, in my opinion, to get back down to a 0% Fibonacci here on the Webull, which remember, metkevin.com/Webull for up to 12 free stocks. What's really remarkable here is we would, in my opinion, need to have more fear than what we had this summer when it felt like inflation was out of control. And even with these expectations today for tomorrow, I don't see that. I just really don't see how we could really get more fear than what we had this summer. It's possible. It's entirely possible that we could hit lower lows, but we would have to have some really terrible news. Inflation would just have to be completely out of control and unhinged to where we would have to get Paul Volcker to go even lower. So, I hate putting my neck out there because people make fun of you for it, but me personally, at least, I don't see catalysts for us being able to go below that 268 number. Can we bob around the 23 to 38% Fibonacci, which is like the 300 to 318? Yeah, absolutely. However, I think if we beat expectations tomorrow, and that is to the better side, and we have lower inflation, I think we'll very quickly solidify 318, 319 again on the NASDAQ as a floor. If we miss, then we'll probably go right back to about 299 on the QQQ. We could have a minus 3% day tomorrow and sit right back to that 299, 300 level. So we'll see what happens. Fingers crossed. I'll be there with you. Really appreciate you. Thank you so much for watching. Check out the courses linked down below. Use the coupon code. Go to metkevin.com/Webull for Webull. And of course, go to House Hack to learn more about my new startup, House Hack. Thanks so much. Goodbye.